Pause for a second and do not skip past this, because if you are over 60 or you are getting close, there is a real IRS rule change that can quietly cost you thousands of dollars, and many seniors do not even realize it exists. This is not a scam, not a rumor, and not some fear-based gimmick. It is an IRS rule change already in effect, and if you miss it, even by accident, the penalty alone can wipe out years of savings. The worst part is that the people getting hit the hardest are often the ones who did everything right their whole lives, followed the rules, saved faithfully, and still get blindsided by one small misunderstanding. Stay with me through the full breakdown, because a simple mix-up about required minimum distributions can mean handing the IRS money you never needed to pay, and the goal here is to show you how to avoid that mistake with clarity and confidence. If you have ever wondered why nobody explains this in plain English, you are not alone, and that is exactly why content like this matters. Seniors, retirees, and families deserve straight answers without fear, hype, or confusion, especially when the stakes are your retirement money. This is where we cut through the noise and translate IRS rules, Social Security updates, Medicare changes, and retirement planning topics into language that actually makes sense, so you are not caught off guard by fine print. If you want ongoing, clear explanations before changes cost you money, hit subscribe right now, because this topic is not a one-and-done conversation. It is a moving target that affects real households. Now watch this, because what has been making waves in the senior community is a newer IRS rule situation that leaves a lot of people worried and confused, mainly because most seniors have not heard the full story yet, and that information gap is exactly where costly mistakes grow. Before getting into the details, let me make one thing crystal clear. This is not about trying to scare you into thinking something is wrong with your accounts, and it is not about panicking over something that does not apply to you. This is real. It is important, and understanding it can save you thousands in penalties and taxes you absolutely do not need to pay. So what is the rule at the center of all this? It focuses on required minimum distributions, commonly called RMDs, and the significant changes that have occurred over the past few years that many seniors simply are not aware of. If you have money sitting in a traditional IRA, a 401k, or other tax-deferred retirement accounts, this applies to you because these are the accounts where taxes were postponed when you contributed or grew the balance, and the government eventually expects its share. The basic idea of required minimum distributions has been around for a long time, so the concept itself is not brand new territory. What changes in a major way is when you must begin taking distributions and how much you must withdraw each year once the rules apply to you. The IRS does not allow you to leave money in tax-advantaged accounts forever because you received a tax break when that money went in, meaning you did not pay income tax on it at the time you earned it. And the government ultimately wants to collect taxes when the money comes back out. Here is where things get interesting and where the confusion really starts to stack up, especially for retirees who built plans around the older rules. For decades, it was straightforward. Once you reached age 70 and a half, you had to start taking money out of your retirement accounts whether you needed it or not. And you had to pay income taxes on those withdrawals. So advisors built retirement income strategies around that age. Families planned budgets around that age. And most people felt they knew what to expect. Then Congress passed legislation called the Secure Act and later followed with Secure Act 2.0, and those changes reshaped the entire timeline in a way that disrupted long-standing expectations. One major shift moved the starting age for required minimum distributions. Instead of beginning at 70 and a half, the starting age became 72 for people who reached 70 and a half after the cutoff described in the rule. On the surface, that sounds like good news, and in many cases it is, because it gives your money extra time to grow tax-deferred, adding flexibility to retirement planning. But here is the mistake that quietly drains bank accounts. Many seniors who reached 70 and a half in 2020 or 2021 or even later did not realize the rule had changed, and confusion started pulling people in opposite directions. Some people began taking distributions at 70 and a half as they believed they had to under the older rules, and that is not a problem because there is no penalty for withdrawing money from your own account. It may not be necessary, but it is allowed. Others delayed taking distributions because they thought they still had to start at 70 and a half and got tangled up trying to follow what they believed were the correct requirements, not realizing the new start age gave them until 72. And the IRS was not exactly running a massive public awareness campaign to ensure every senior understood the change. And just when many people thought they finally understood the update, it got even more complicated, and this is the part most seniors have not heard explained clearly. Secure Act 2.0, passed as part of a larger spending bill, pushed the starting age back again based on birth year. If you were born from 1951 through 1959, your required minimum distribution age is 73, and if you were born in 1960 or later, you do not have to start taking required minimum distributions until age 75. Let that sink in, because it is huge. If you are in your early 60s and your birth year is 1960 or after, the rule says you have until 75 before you are required to start pulling money out of traditional retirement accounts. It is easy to hear that and think, that sounds great, more time for growth and more flexibility. And you are right, it can be beneficial. But what most people miss is that the biggest financial damage is not only about picking the wrong start age, although getting that wrong can absolutely create problems. The real danger is misunderstanding the penalty structure and failing to plan for the tax impact of these withdrawals. Once you reach your RMD age and you do not withdraw the amount you are required to take for a given year, the IRS assesses a penalty, and this is not a tiny fine you shrug off. The penalty used to be 50% of the amount you were supposed to take, but did not, which is brutal when you do the math. Picture this. If your required withdrawal is $10,000 and you forget, or you did not know, or you simply did not get it done, the IRS could charge a $5,000 penalty, and that is on top of still requiring you to take the distribution and pay the income tax on it. That is a double hit, and it has surprised many people over the years. There is a small piece of relief that comes with the newer law changes. The penalty is reduced from 50% down to 25%. And if you catch the mistake and correct it quickly, it might be reduced further to 10%. Even so, 25% or 10% is still real money, and it is money you hand over for no reason other than missing a rule or misunderstanding a deadline, so the best strategy is not to rely on penalty reductions, but to avoid the problem entirely. Now, the calculation itself is another common trap. Your RMD is not a random figure, and it is not a fixed percentage that never changes. It is based on the account balance at the end of the previous year and on your life expectancy using IRS tables. The IRS publishes life expectancy tables, and those tables have been updated recently to reflect that people are living longer than they used to, which can work in your favor because longer life expectancy factors typically mean the required distribution is a smaller percentage of your total balance each year. But you have to use the correct tables, you have to do the math properly, and you have to withdraw enough to satisfy the requirement without pulling out so much that you create an unnecessary tax burden for yourself. Here is another critical detail many seniors do not realize, especially those who have accumulated multiple accounts over a career. If you have 3 traditional IRAs at 3 different financial institutions, you must calculate the required minimum distribution for each IRA separately based on each account's balance. And that separate calculation step matters. The slightly good news is that for IRAs, you can add up all those individual RMD amounts and then withdraw the combined total from a single IRA if you want. You do not have to take a little from each one, and you can choose the account that makes the most sense for your strategy. However, And this is a big however. That flexibility applies to IRAs, not to old 401k plans. If you have multiple 401k accounts from previous employers, the rule requires you to take the required minimum distribution from each 401k separately, and you cannot combine them the way you can with IRAs. That single detail trips people up constantly, and it is exactly the kind of misunderstanding that can lead to missed distributions and expensive penalties. Now let's talk timing, because this is another place where mistakes happen and people do not realize it until it is too late. In general, the required minimum distribution for a given year must be taken by December 31st of that year. But there is one exception that creates a serious planning trap if you do not understand it. In the first year, you are required to take an RMD, meaning the year you reach your threshold age, whether that is 73 or 75 based on your birth year, you are allowed to delay that first required distribution until April 1st of the following year, a deadline known as your required beginning date. That sounds like breathing room, and it can feel like a helpful extension, but here is the trap. If you wait until that April 1st deadline to take the first required minimum distribution, you still must take the second RMD by December 31st of that same year, which means you end up taking two distributions in one calendar year. Two taxable distributions in 1 year can shove you into a higher tax bracket, affect your Medicare premiums, and trigger tax consequences you are not prepared for. So even though the delay option exists, it is often not the smartest move from a tax planning perspective. And that brings us to the tax reality, because this is where good planning can save a tremendous amount of money. Every dollar you withdraw as a required minimum distribution is taxed as ordinary income, not as capital gains and not as qualified dividends with preferential rates. And it gets taxed at your normal income tax rate. Depending on your total income for the year, that federal rate can run anywhere from 10% up to 37%, and state income taxes may apply on top of that. If you still work part-time, receive a pension, or collect Social Security, all of that income stacks together and the RMD sits on top of it, which is why so many retirees are shocked when an RMD pushes them into a tax bracket they did not expect, and suddenly they are paying a higher percentage in taxes than they believed retirement would require. There is also a Medicare premium impact that catches many seniors completely off guard, and almost nobody talks about it enough, even though it should be part of your planning. Medicare. Part B and Part D premiums are tied to your modified adjusted gross income from 2 years earlier through a surcharge system called IMA, which stands for Income-Related Monthly Adjustment Amount, and it can significantly increase what you pay for Medicare if your income crosses certain thresholds. Those thresholds are not as high as many people assume. If you are single and your income is above $97,000, or if you are married filing jointly and your income is above $194,000, you start paying higher Medicare premiums, and those surcharges can add hundreds of dollars per month to what you pay. Now, imagine you take a large RMD you did not plan for, it pushes your income over one of those IMA thresholds, and then 2 years later, you are paying noticeably more for Medicare, and you cannot figure out why. This happens to people all the time, and with proper planning, it can be completely avoidable. So what can you actually do about all of this, and what strategies can reduce the impact of required minimum distributions so you keep more of your hard-earned money working for you instead of losing it to avoidable taxes and penalties? First, you need to know the rules that apply to you specifically based on your birth year, because the starting age is not one size fits all anymore. Confirm exactly when your RMD requirements begin, put it on your calendar, set reminders, and make sure the deadline does not slip by. If you work with a financial advisor, demand that they are on top of this and that they explain the plan clearly. If you manage your own accounts, understand that many major brokerage firms may calculate your RMD and may even send reminders, but you still have to take the distribution because they cannot force you to do it. One powerful strategy for certain people is a qualified charitable distribution, known as a QCD, and it can be a real game changer if you are charitably inclined. Once you reach age 70 and a half, notice not your RMD age, but 70 and a half specifically, you can direct up to $100,000 per year from your IRA straight to a qualified charity, and that amount counts toward your required minimum distribution while not counting as taxable income to you. Think about how strong that is. You meet the RMD requirement, you support causes you care about, and you avoid paying income tax on that portion. You do not receive a charitable deduction for it, but by excluding the distribution from your income in the first place, you are essentially getting a similar benefit. And for people who do not need their full RMD for living expenses, this is one of the most tax-efficient tools available. Another strategy that fits into proactive planning is Roth conversions, and this is usually best considered well before you hit your RMD age, not after you are already facing mandatory withdrawals. Required minimum distributions apply to traditional tax-deferred retirement accounts, not to Roth IRAs. So if you convert some or all of your traditional IRA money into a Roth IRA, you pay taxes on the conversion in the year you do it, but then that money grows tax-free, and you are not required to take RMDs from it. This can be especially smart in years when your income is lower, such as early retirement years after you stop working, but before you start collecting Social Security, or before RMDs begin, because you may be in a lower tax bracket then, making it potentially more efficient to pay taxes on conversions earlier, rather than being forced into larger taxable distributions later when you might be in a higher bracket. The bottom line is this. The biggest mistake seniors make is not only misunderstanding the exact age when RMDs begin, though that confusion is real now that 72, 73, and 75 can apply depending on your situation, but failing to plan ahead, failing to understand the penalty structure, and missing the full tax and Medicare consequences that required withdrawals can create. The rules have changed significantly, the details are more complex than they used to be, and if you are not paying attention or you are not working with someone who understands the nuances, you can end up leaving money on the table or, worse, paying penalties and taxes that never had to happen. If you are approaching retirement, or if you have parents or loved ones in this age range, make sure this conversation happens because you want a plan in place before the deadlines arrive, not after a costly mistake. Know when distributions must start based on birth year, understand how amounts are calculated using account balances and life expectancy tables. Remember that IRA RMDs can be totaled and taken from one IRA, while 401k RMDs must be taken from each plan separately, and treat the December 31st deadline and the April 1st first-year option with the respect they demand, because the goal is not just compliance. It is doing it in the most tax-efficient way possible, so your retirement savings stay where they belong, working for you, not getting drained by avoidable penalties and surprises.